Welcome to the Rudick Report. It's Thursday, December 15th, 2022. We see a lot of talk lately about whether we are in recession or whether we are not in recession. And it has even come to where certain political parties have redefined the term recession to fit their narrative. But when mainstream media reports that Blackrock says to prepare for a recession unlike any other, then people listen. Not sure why that is. It must be some sort of bias against alternative media sources, but nevertheless, it is now being reported across multiple news sources. This particular article comes from the Market Insider, and they report that a worldwide recession is just around the corner as central banks boost borrowing costs aggressively to tame inflation. And this time, it will ignite more market turbulence than ever before, according to BlackRock. The global economy has already exited a 4-decade era of stable growth and inflation to enter a period of heightened instability, and the new regime of increased unpredictability is here to stay, according to the world's biggest asset manager. That means policymakers will no longer be able to support markets as much as they did during past recessions, a team of BlackRock strategists led by Vice Chairman Philip Hildebrand wrote in a report titled The 2023 Global Outlook. Quote, recession is foretold as central banks race to try to tame inflation. It's the opposite of past recessions, they said. Central bankers won't ride to the rescue when growth slows in this new regime, contrary to what investors have come to expect. Equity valuations don't yet reflect the damage ahead. The prospect of limited policy support means investors need more dynamic methods involving more frequent portfolio changes and taking a more granular view on sectors, regions, and sub asset classes to navigate the volatility ahead, according to BlackRock. Most people set their 401ks or their investments with a 60-40 split between equities and bonds, and they let that ride for decades and hope for the best. But that's not going to be the case moving forward, according to BlackRock. Quote, what worked in the past won't work now, the strategist said. The old playbook of simply buying the dip doesn't apply to this regime of sharper trade offs and greater macro volatility. We don't see a return to conditions that will sustain a joint bull market in stocks and bonds of the kind we experienced in prior decades. Wall Street banks from Morgan Stanley and Bank of America to Deutsche Bank have warned that the U.S. stocks could plunge by more than 20% in 2023 due to an economic downturn and liquidity risks fueled by the Federal Reserve's interest rate increases. Some firms have even warned of a steeper decline. A slowdown in the housing market, delays in corporate investment plans, a decline in consumer savings, and a deteriorating CEO confidence are early signs of the oncoming economic slump, according to BlackRock. Still, the stock market hasn't yet factored in the potential magnitude of the impending economic downturn. We don't think equities are fully priced for recession, they added. Corporate earnings expectations have yet to fully reflect even the modest recession. This keeps us tactically underweight developed market equities. The S&P 500 index of large cap US stocks is up more than 12% from a 23-month low reached in October, spurred mainly by expectations that the Federal Reserve will slow the pace of its interest rate increases after a recent retreat in inflation. So we see that most of the investors believe that the Fed will pivot and slow down their interest rate hikes. Therefore, you see the stock market in that tug of war lately. One day up 500, the next down 900. It is all hinged on the Fed's participation to the extent of being the buyer of last resort. They had indicated they were winding down their balance sheet, but it seems to me that central banks across the board are all deeply involved in the purchase of assets. Meanwhile, the common person is struggling with the effects of inflation. These include rising fuel costs, food costs, and increased costs across the board as inflation grips the country and limits the amount people can afford. If this wasn't enough, we see that countries are preparing themselves for the eventual move away from the dollar. The BRICS nations, particularly, have had enough of the advantage the USA has had with the reserve currency, and they are moving quickly across the board to buy and sell in other currencies as their appetite for gold has increased year over year into the metric tons. It appears countries know that the dollar eventually will lose its reserve status, and they are preparing with alternate assets. This is not financial advice, but personally, I would start investing in these assets as well, in preparation for that eventuality. Gold and silver are as stable as you can get and have been around for thousands of years. Thank you for listening. Please like and subscribe, and we'll see you with our next report.